So we're going to look at the benefits of refinancing and especially around consolidating other debts. So what we've got in front of us is a refinance summary spreadsheet. So in this case, we've got a $500,000 loan that's expiring September next year. Let's just change that to this year. Simplify things a bit. So it's coming up soon. Current interest rate is relatively good, 4.49 annual interest costs. So what does it look like if you were to refinance this $500,000 loan from one bank to another? So let's say there's a small break fee because the rate is already relatively low. You'd be thinking, why am I going to do this? Well, one of the major reasons is you want to lock in this low interest rate now. So this is not a bad 1 year rate, and you want to get $3,500 in cash back. So this cash back is an incentive for joining a new bank, and it's added to your bank account when you join this new bank. So what does this look like? So the difference in your interest expense in that period to September 2018, you'll pay $585 less interest to the bank over that period. You'll get $3,500 into your bank account. That's less the break fees, less the legal fee. So the benefit of refinancing right now, even though you've still got a loan ongoing, is $2,885. So that's pretty good. What I'd also like to show you is another example. This is a client that I've been working with this week. He's refinancing from Kiwi Bank to another bank. So his loans are as follows. He's got some coming up May next year, some that's just come off refix now, and this is his floating. So we just work out the floating rate on 1 year. So his current floating rate is 5.85. He could get that down to 5.25. He just has to know how to ask. And so he can take his current rates, put them on that 4.19. I think he's actually getting a better rate than that. Less his break fees, relatively small break fees because, Kiwi Bank's not charging big break fee on these loans. So what do the numbers look like? On top of consolidating his 20 grand credit card debt into his mortgage, and I'll explain that in a second, he's going to get $5,200 cash back. His interest savings between now and that period of if he didn't refinance and between refinancing and not, because he's getting these lower rates, he's going to save $4,681 in interest expense in that period between now and May 19. Less his legal fee of $900, he's going to save $8,385 by refinancing now. And I want to show you the difference between consolidating debts and not. So here's credit card, around $20,000. He's paying more than 17% interest on that at the moment because he hasn't kept up with it. And this is pretty common. There's a lot of people with Q cards, Visa, a whole bunch of credit cards from different banks, and consolidating to the mortgage is pretty common. So his annual interest expense for that credit card, if he doesn't sort it out, is $3,400. He can get that down where it's going to cost him much less. So his potential cost per annum is going to be less than $900. So you can see there's a big difference between paying 17% and putting it on the mortgage. So if we took that credit card debt out, he's still saving $5,800 by refinancing. But because that credit card is in there, he's saving a lot. And what this means is he can manage his monthly repayments. He'll pay the debts off a lot faster because the interest rates are lower, and he can, almost hit like a reset button. So he's feeling a lot more comfortable about things, and this cashback really does help. So another example of a refinance where somebody's actually, in this case, going from really low rates to slightly higher rates, but because their mortgage is so big, their total lending in this instance is, over 1.8 mil. Their cashback is going to be $10,000 or more. There's no break fees, and even though they have to pay a legal fee across two properties of around about $2,000, they're going to save over $6,700 in refinancing, and they're going to be able to separate securities. They're going to be able to restructure or set new terms on the mortgages if they'd like. And there's a bunch of other reasons why somebody might refinance from lower rates onto higher rates. But you can see it's counter to your normal thought of why you would go from 4.25 for 2 years to 4.3, but it's because of this cashback. Cashback is such a strong motivator. It's money in your bank account the week that you switch. And if in this example, let's say, which is again pretty common, there was 30 grand of credit card debt on 18%, and they're going to refinance it. You can see that the total savings goes up over $10,000. So they've gone from less than $7,000 to over almost $11,000 of savings by consolidating their credit card debt. And people will complain, hey, now you're paying your credit card off over 30 years instead of one. But a lot of people aren't going to catch back up on that credit card debt. And you can actually, if you're more disciplined, pay the debt off a lot faster by having a lower interest rate. And there's no reason why, in this case, this client can't make lump sums each year. They're paying less towards their interest repayments. They can build up a little bit of a revolving credit or offset account, and they actually pay the debt off a lot faster because the interest rates are lower. So make sure you're talking with somebody that knows what they're doing in terms of consolidating debts, that you're not just taking one credit card debt and putting it into another credit card, where you might as well just lock in some low rates and focus on the whole debt rather than just a little amount of it.